live from Bloomberg's world headquarters in Midtown Manhattan. I'm Matt Miller.
And I'm Kaylee Lyons. Welcome to Bloomberg Crypto, a look at the people, transactions, and technology shaping the world of decentralized finance.
Coming up, an exclusive conversation with Sam Bankman-Fried. The crypto billionaire joins us to talk strategy and succession as his deputy steps down.
A little over a year ago, Sam Bankman-Fried told the press that one day he hoped to buy Goldman Sachs and maybe the Chicago Mercantile Exchange. And of course, the people at Goldman and the CME would have been delighted to hear this at the time when crypto was really hot back then, which is around July 2021. And to get an idea of who is Sam Bankman-Fried, well, he's the owner of FTX, the now bankrupt crypto exchange, and Armada Research, the now bankrupt crypto hedge fund. To understand the severity of the situation involving FTX, the Financial Times has reported that there are about 130 affiliated companies referenced in the bankruptcy filing. Sam Bankman-Fried's trading firm Alameda Research allegedly owes his crypto exchange FTX $8 to $10 billion after taking loans that were possibly funded by the deposits from FTX customers. This is all according to the Wall Street Journal. Both Alameda, the hedge fund, and FTX, the exchange, are controlled by Sam, who issued an apology on Twitter saying that he should have done better, followed by some legal disclaimers that don't look like they were written by an actual lawyer. So FTX allegedly lent over half of its customers' funds to Alameda, who then used those funds to bet on other cryptocurrency and to help out other crypto firms that have been struggling during the year. For example, BlockFi. Alameda Research was run by 28-year-old Caroline Ellison, a die-hard Harry Potter fan, according to the news. The venture capital firm Sequoia Capital had a magazine-style article on their website, which has now since been deleted, no surprise, and it read, this is basically what it said, and this is basically what it was titled specifically. Sam Bankman-Fried has a savior complex, and maybe you should too. That doesn't sound too good right about now. But the article described how when Allison met up with Sam to learn about what he was doing in the crypto industry, she was dressed as a sultry wood nymph. Just hearing that doesn't really give me a lot of confidence for the cryptocurrency industry. But yes, they also included a photo in the article. What they really planned to do by introducing Sam Bankman-Fried and FTX in this manner, I have no idea. Maybe it was just a new way to enter the industry, to come out with a bang. Who knows? But apparently investors at Sequoia lit up when Sam Bankman-Fried was pitching to them for investment. Partners were apparently freaking out. But anyhow, the piece goes on to describe how the round raised $1 billion, which was followed by a meme round where $420.69 million was raised from 69 investors. I know what we're all wondering: how did all of this money disappear? Well, FTX was valued by its VC investors at $32 billion only a few weeks ago, and it appears to be worthless today. It is bankrupt. This is not an assumption. This is actually documented. They filed for bankruptcy. Well, FTX issued a token called FTT. And this token might seem a bit like stock or equity ownership in the exchange, but it's not. Legally, a token like this can't be too much like equity, or the issuer would get in trouble with the SEC. The FTT token is a bit more like a points program from a store, let's say like the point system with Best Buy, okay? If you buy these tokens, you don't get an ownership stake or guaranteed interest payments from FTX like you might with a corporate security. You instead get perks like discount on trading, The other feature, which is quite important, is that FTX had agreed to use a portion of its profit to buy back FTT tokens. And so this makes the token behave somewhat like stock in FTX. As the more profitable FTX is, the more of these tokens it will buy back, hopefully pushing the price up. So FTT is, to a certain extent, a bet on FTX profits. Sort of like gambling. Kind of like stock. But while it is legally not stock, as FTX actually does have real stock owned by their investors like Scotia, Tiger Global Management, the Ontario Teachers Pension Plan, and of course SoftBank, and I'm guessing they're not pretty happy at the moment. This FTT token behaves like stock, in which it would be expected to rise and fall with the profitability of the exchange. Alameda, the hedge fund, was supposed to have $14.6 billion in asset as of the end of June 2022. But its biggest asset included $3.7 billion worth of unlocked FTT, and its third biggest asset was $2.2 billion worth of FTT collateral. The liability side of the balance sheet was dominated by $7.4 billion worth of loans. So this is a problem, as it is almost like a company using its own equity as collateral on a loan. If the company does badly, which is a problem on its own, that is bad. But if the collateral backing its loan is falling in value at the same time, that's nightmare from a risk perspective. Most risk managers would notice this, but the head of risk at FTX was another teenager, apparently, who had 2 years of risk management experience at Credit Suisse. And how this financial institution always finds its way into these type of scenario, whether it's directly and indirectly, I will never know. But it would definitely be worth looking into. But in an appearance on a podcast a few months ago, Sam Bankman-Fried described how value could be created from nothing using tokens. His explanation left Matt Levine, who was also a guest on the podcast, totally speechless. I'm guessing probably because they're thinking to themselves, this sounds like a Ponzi scheme. What SBF described in the interview was eerily similar to what many suspect FTX and Armada were actually engaged in. Ponzi scheme. FTX token price was said to be being propped up by Alameda, and Alameda was allegedly using the token as collateral to fund its own trading activities. Sam Bankman-Fried founded Alameda initially to do crypto arbitrage trading, and then he founded FTX afterwards so that he would have a better exchange for Alameda to trade on. These firms are very tied to each other, and the fact that Alameda has a lot of FTX tokens is not great on its own, as it means that it is illiquid and they might need to sell these tokens down to cut risk, and that would push the price of the token lower. But that on its own is not enough for a run on FTX. The real reason for the run on FTX is if customers believe that FTX lent Alameda a bunch of customers' assets and got FTT tokens back in return. In that case, a fall in the price of FTT would destabilize FTX, the exchange. So that explains why things were unstable at FTX. Once word got out that Alameda balance sheet looked what Alamada's balance sheet looked like, the founder of Binance, CZ, announced on Twitter that he would sell his FTT holdings due to recent revelations. Now, normally, people don't announce a big trade in advance of doing it, but the founder of Binance announcement and selling caused FTT's price to plummet, and traders then rushed to pull out of FTX for fear that the firm would collapse. Following that situation, on a Monday, Binance announced that it had reached a non-binding agreement to bail out FTX by buying the company. Then the following Wednesday, Binance announced that it would no longer be buying FTX as a result of corporate due diligence, meaning they found out what Sam Bankman-Fried was doing how deep in a hole that he actually was with FTX and decided to bail out. They also cited regulatory investigations and reports of mishandled funds. On that same Wednesday, Sam Bankman-Fried tweeted that he mistakenly believed that FTX customers had plenty of liquidity earlier this week to facilitate withdrawals. He was not aware of leverage within the FTX system, which I highly doubt, and he said that he could not have gotten it more wrong. To better understand FTX's position in the crypto world, understand this: crypto exchanges are in many ways more like broker-dealers than they are like traditional exchanges. Exchanges match traders, allowing them to execute orders with each other, while brokerage transact with their clients directly. A lot of FTX business in perpetual futures, where traders trade a derivative on the cryptocurrency, often with leverage. A crypto exchange thus need to come up with the money to lend to their customers. FTX might have borrowed that money from Alameda, the affiliated hedge funds, or they might have borrowed it from their customers, which is still not a good thing. Now, once an exchange is borrowing and lending money like that, the business is a whole lot like a bank. And if all of the people they have borrowed money from demand to be paid back at once, they have a bank run on their hands. Sam Bankman-Fried was claiming that FTX was illiquid but not insolvent, and he was shopping around for a multi-billion-dollar cash infusion to bridge any cash flow gaps. A liquidity problem is when a firm has enough money but can't access it quickly enough. The classic example would be a savings and loans bank where all of the depositors want their money back at once, but the bank has lent a lot of it out to home buyers and local businesses. The money is there, it just can't be accessed quickly enough to be returned to the depositors. A solvency problem now is when a firm has simply lost all the money. These two things can have some overlap, as a run on a bank, which might be a liquidity problem, is most often caused by the bank customers worrying about the bank's solvency. So liquidity problems can turn into solvency problems, as if a firm is forced to sell assets quickly to meet liquidity problems, the selling can push the price of those assets down. The selling pressure pushes the value of the asset below the value of the liabilities, and now a liquidity problem has become a solvency problem. No matter how you look at it though, a liquidity problem is something that is easier dealt with than a solvency problem, as if you can find a way of buying enough time to sell your assets slowly and at a fair price, you can pay everyone back what you owe them. For example, the panic of 1907 is a famous example of the financial crisis caused by the banks lending to speculators who lost their money. Well, lending to people who gambled their money. Okay, there were bank runs that spread throughout the nation, and this is when J.P. Morgan famously lent out his own money to prevent the complete financial collapse. Only a few months ago, Sam Bankman-Fried was being compared to J.P. Morgan for his offers to bail out a lot of crypto businesses. I'm guessing this is no longer the case. If the issue at FTX is just a liquidity problem, then someone could, in theory, step in and rescue the situation. In banking, the Federal Reserve is required to lend freely against good collateral at a penalty rate in such a situation. The lending should ease the liquidity problem, and the penalty rate means that the bank is punished financially for getting itself in such a position. For example, Warren Buffett provided capital to Goldman Sachs during a credit crunch in 2008. Berkshire Hathaway bought $5 billion worth of preferred shares that paid a 10% dividends. That's a great return for dividends. And the day after the deal was announced, the public now had more faith that the firm was well capitalized, so they weren't in a rush to take out their money, but instead they bought stocks that were now readily available. So if Binance, in theory, had bought out FTX, it wouldn't have been surprising if the price had been close to zero. The difficulty for a crypto exchange in a situation like this is that there are going to be fewer people interested in getting involved given the risk factor. Now, Scotia Capital had announced that they will be making their investment over $210 million down to zero. That's quite understandable when FTX has a $10 billion hole in their balance sheet. Now, at the time, Sam Bankman-Fried claimed that FTX US, the US-based exchange, was 100% liquid. It's not really believable because FTX's former head of institutional sales has been quoted as saying that only 10% of FTX $8.8 billion in customers' funds were backed by liquid asset. Venture capital funds like Scotia, who valued the firm at $32 billion and a few months ago, will have lost a lot of money in this, right? It seems likely that the customer funds are compromised too, as I don't know how an $8 billion balance sheet hole could have been developed without the exchange lending out customer funds, really. Okay? And for no one to keep track of this and for no one to be aware of this is highly unbelievable. Reuters reported that FTX lent customer funds to Alameda Research after it was hit hard by the failures of Three Arrow Capital's Voyager in May of this year. Around the same time, Brett Harrison, the president of FTX US, got in trouble with US regulators for a tweet that contained misleading claims that funds held at FTX were FDIC insured. You just don't do that. You're lying at that point. So it might be reasonable, based on this unethical behavior that went on, to think that there were problems at FTX and that FTX really needed their customers to leave their money on the exchange. The U.S. Justice Department and U.S. regulators are now investigating the relationship between FTX and Armada, including whether customer funds may have been misused. If customer funds have been lent out, FTX customers seem like they will lose a substantial part of their funds. BlockFi, a digital asset lending platform, paused client withdrawals, saying that it could not operate its business as usual because of the lack of clarity on the status of FTX and Armada. FTX had bailed out BlockFi during the crypto crisis earlier this year, extending it a $250 million loan. The collapse all comes less than a month after FTX was poised to carry out a Series C funding round matching its $32 billion valuation from January. Now, the ongoing crisis of FTX and BlockFi, and before that, Celsius, Voyager, Three Arrows Capital, Terra, and Luna, and the list keeps going, has less to do with cryptocurrency overall, but instead it highlights the problem in financial systems where there are no checks, balances, and due diligence in place. As for the whereabouts of Sam Bankman-Fried, he is understood to be in the Bahamas and is under supervision by the local authorities. A report from the Wall Street Journal on November 9th suggested that the U.S. Department of Justice and the Security Exchange Commission are investigating the collapse of the crypto exchange. The Department of Financial Protection and Innovation in the state of California announced on November 10th that it will open up an investigation as to the apparent failure of the exchange. Now, how this will turn out, it's hard to say, but we can definitely say that Sam Bankman-Fried is in a lot of trouble, and this is one of the financial booms that will forever be plastered in the financial history. Thanks for watching. If you want to see more videos like this, subscribe and like the video.